If you had walked into a Napa Auto Parts store back in 1948 and bought stock in Genuine Parts Company that day, you would have received a dividend increase every single year since. 70 consecutive years. Wars, recessions, dot-com crashes, a global pandemic, the check always went up.
That is genuinely rare. We're talking about a company that has delivered rising income through every major market dislocation of the last 7 decades. That's not luck. That's a business model built for durability.
And yet, right now, GPC is sitting roughly 25% below its 52-week high, announcing the biggest structural change in its nearly 100-year history, and just posted a first-quarter revenue beat that most people aren't talking about. That's a story worth telling.
Let's get into it.
Genuine Parts Company was founded in Atlanta in 1928. Carlisle Fraser purchased a modest auto parts depot for $40,000, renamed it, and built what would become the largest automotive replacement parts distributor in the world.
Today, the company runs 2 major business segments. Global Automotive, that's the Napa brand everyone recognizes, generated roughly $15 billion in revenue last year. And Global Industrial, which operates as Motion Industries, added about $9 billion, serving manufacturing, food and beverage, and energy customers with bearings, hydraulics, and automation components.
Together, they made GPC a nearly $25 billion revenue business, operating across 17 countries with over 10,800 locations. And here's the key thing about how they make money. About 80% of Napa's automotive sales come from professional repair shops and fleets, not consumers.
That distinction matters enormously. Professional installers cannot wait 2 days for a part. A car sitting on a lift is lost revenue. GPC's density, 51 dedicated distribution centers in the U.S. alone, means same-day delivery across most markets. That is a moat you cannot build overnight.
They also carry over $2 billion in private label parts revenue under brands like G-Force and Economy, giving them pricing flexibility competitors don't have. And Motion Industries serves over 200,000 industrial customers with 19 million parts in inventory.
The private label business is underappreciated. It lets GPC compete on value without eroding its OEM supplier relationships, and it drives margin structure that pure pass-through distributors can't replicate.
Running this transformation is Will Stengel, who became president and CEO in June of 2024, only the second CEO in the past 15 years, and only the 9th in the company's entire 96-year history.
Stengel joined GPC in 2019 specifically as Chief Transformation Officer. That title tells you everything about why he was brought in. His background is at HD Supply Facilities Maintenance, where he served as president and CEO, plus senior leadership at the Home Depot and investment banking before that.
The board recruited an operational restructuring expert, and he has delivered. The cost reduction programs he oversaw generated $175 million in annualized savings through 2025. He's now targeting another $100 to $125 million in incremental savings in 2026.
And his defining move as CEO is the February 2026 announcement of a separation plan, splitting GPC into 2 independent public companies by 2027. Global Automotive becomes one entity, Global Industrial becomes another. Pure play focus, distinct valuations. That is a significant strategic bet.
Wall Street reception has been mixed. Evercore ISI is firmly in the bull camp, maintaining their outperform rating. Truist dropped to hold after the Q4 miss. But the consensus seems to be, the strategy is right, execution is the open question. Lana, let's talk numbers, because Q1 2026 was a tale of 2 metrics.
It really was. Revenue came in at just over $6.26 billion, beating analyst estimates of $6.16 billion by over $100 million. That's a clean top-line beat driven by comparable sales growth of 2.4%, acquisition contribution of 1.3%, and favorable currency tailwinds.
And the earnings per share?
Adjusted EPS of $1.77, barely edging the consensus estimate of $1.75. The GAAP figure was lower due to separation-related charges, but on an adjusted basis, GPC crossed the bar. The revenue line was the stronger story.
Walk me through the valuation picture.
At a stock price of roughly $113, GPC trades at about 14.7 times forward earnings, using the full year 2026 consensus estimate of $7.72 per share. Price to sales is just 0.64 times on a trailing basis, extremely modest for a company with this kind of distribution reach. Price to book is 3.5 times.
That PS is eyebrow-raising for something this established.
It reflects the margin compression the market is pricing in. Gross margin in Q1 was 37.3%, which is solid for a distributor. But operating margin came in at just 4.6%. That's the tension. Top line is fine, operating leverage is the problem.
What about the cash situation?
GPC carried about $500 million in cash at quarter end against $6.7 billion in total debt, netting out to around $6.2 billion in net debt. The current ratio is 1.09, just barely above 1, but not alarming for a distributor that runs tight working capital. Quick ratio is 0.48, reflecting the large inventory base.
Free cash flow?
Q1 operating cash flow came in at just $64 million, seasonally weak, as the first quarter always is for GPC. On a trailing 12-month basis, operating cash flow is closer to $880 million, with free cash flow around $490 million. The dividend costs about $580 million per year at the current rate.
So they're running a bit tight on free cash flow coverage of the dividend.
Correct. The payout ratio is roughly 55% on an adjusted earnings basis, which is sustainable, but the free cash flow coverage is thinner than I'd like. That's worth watching if restructuring costs run higher than expected.
Dividend yield for anyone keeping score.
About 3.75% at current prices, with the annual payment of $4.25 per share, a 3.2% raise from 2025. That's the 71st year of increases coming.
Overall take on the financial health.
Overall, Genuine Parts Company's financial health is watchful. Revenue is growing, the dividend is secure, and restructuring savings are flowing through. But EBITDA missed expectations in Q1, the balance sheet is leveraged, and the separation will cost money before it saves money. The trajectory is the right one. The execution is the open question.
Wall Street's consensus is hold on GPC, 14 analysts tracked, with 5 buys, 8 holds, and 1 sell.
The average price target is around $140, implying about 23% upside from where the stock is trading. Target range runs from 120 on the low end to 175 on the high end.
The notable action came on February 18th, when Truist Securities downgraded from buy to hold following the Q4 2025 earnings miss. UBS maintained its neutral rating, but trimmed its target to 135. Evercore ISI stood firm at outperform.
The Evercore call is the interesting one. They're making the argument that the separation unlocks significant value, that two focused pure-play entities will command higher multiples than the blended conglomerate does today. That's essentially a sum-of-the-parts thesis.
Does that math work?
It can. Industrial distributors with strong e-commerce penetration, and Motion is already at 40% digital sales, tend to trade at higher multiples than traditional auto parts distributors. If Motion can demonstrate standalone growth metrics, it might deserve something closer to Grainger's valuation.
And Napa standalone?
Napa would be compared directly to AutoZone and O'Reilly. The professional mix is stronger, the yield is higher, and the multiple would likely reset once the separation noise clears.
Let me make the bull case. 1. The separation. 2 independent public companies means 2 sets of management focused on one thing, 2 tailored capital allocation strategies, and a likely re-rating once the market can value each business cleanly. That alone could unlock significant value without GPC having to grow its revenue a single dollar.
And the bear case is equally straightforward. The execution risk on a separation of this scale is real. Splitting a $25 billion, 17-country, 63,000-employee organization into 2 public companies is not a 6-month project. Costs will run during the transition. SG&A inflation is already outpacing revenue growth, and the Q1 adjusted EBITDA came in below expectations even before separation charges.
Long-term structural headwind, electric vehicles.
Over the next 10 years, as EVs grow from a small fraction to a meaningful share of the vehicle fleet, the traditional aftermarket parts demand curve begins to flatten. EVs have dramatically fewer moving parts, no oil changes, no belts, no alternators. Napa's entire installed base of expertise centers on the internal combustion engine.
Bull case counter. The average vehicle on American roads is now 12 years old. The ICE fleet isn't going anywhere for at least the next decade.
Fair, and older vehicles actually need more maintenance, and not less. But it is a long-term demand headwind that investors should price in, even if it's 2035, before it materially bites.
Bull. 70 years of dividend growth means management has lived through every cycle imaginable and kept increasing the payout. That's a cultural commitment, not just a financial metric.
Bear. Free cash flow is thin relative to the dividend commitment, and the separation will consume cash before it generates it. One unexpectedly bad quarter could put the streak under pressure.
How does GPC stack up against its peers?
AutoZone is the consumer-facing auto parts king. They trade at roughly 24 times earnings and about 3 times sales. Their buyback program is legendary. They've shrunk the share count dramatically over the years. But they're a consumer retail story, which is a different risk profile than GPC's professional installer model.
O'Reilly is the other auto parts giant.
O'Reilly trades at around 30 times forward earnings and 3.5 times sales. They've executed exceptionally on the dual professional and consumer model. But that premium valuation prices in continued double-digit EPS growth, and at that multiple, there's limited margin for error.
And on the industrial side, Grainger.
W.W. Grainger is Motion Industries' closest comparison. They trade around 22 times earnings and 1.8 times sales, with about 40% e-commerce penetration already, similar to Motion's profile. The argument for the GPC separation is that once Motion is standalone, it deserves closer to Grainger multiples rather than being dragged down by automotive distribution valuations.
GPC at 0.64 times sales versus those peers. That spread is striking.
It is. But the spread exists because GPC's operating margins are lower, the balance sheet is more leveraged, and the business is mid-transformation. The question is whether the separation closes that gap, and on what timeline.
What's the options market saying about GPC?
Options are trading at the 23rd RV percentile, meaning implied volatility is cheaper than 77% of the past year's readings. Options are historically cheap right now for GPC.
Interesting, given all the headline risk around the separation.
It suggests the market is not expecting a big near-term move in either direction. The put-to-call ratio is 1.24, slightly more puts outstanding than calls, reflecting a modest defensive lean from institutional players hedging their positions rather than making outright bearish bets. No unusual block trades were detected heading into Q1 earnings, and call open interest clusters around the 120 and 130 strikes, with put concentration near 110 and 105.
Low volatility expectation, mild institutional hedging.
That's the read. With the separation timeline extending into 2027, there's no single near-term catalyst that would force a large options move. Traders are waiting, not betting.
What are insiders doing with GPC shares?
SEC Form 4 filings from the 90 days prior to Q1 earnings show limited activity, 1 small open market purchase, and 2 scheduled sales under 10b5-1 programs. Prearranged planned sales are set up months in advance and carry little informational value about management's near-term outlook.
The absence of buying is worth noting.
It is. The stock is trading roughly 25% below its 52-week high, and no executives have stepped in with significant open market purchases at these levels. That's not a sell signal, but it's also not the kind of insider confidence boost that reassures investors during a complex transition.
Let's rapid fire the key risks and metrics to watch.
Separation execution. The timeline is 2027. Every earnings call between now and then will be scrutinized for any hint of delay, cost overrun, or operational disruption.
Margin trajectory.
Adjusted EBITDA margin is the single most important metric. Q1 showed revenue strength but missed on EBITDA. If that gap doesn't close by Q2 or 3, the bull thesis starts to erode.
Inflation.
Management has guided SG&A growth 30 to 50 basis points faster than revenue in 2026, even after restructuring. If inflation in wages and occupancy costs accelerates further, that spread widens and the earnings guidance becomes hard to hit.
Tariff environment.
GPC built in roughly 2% pricing benefit from the current tariff environment into their 2026 guidance, Any significant policy reversal or escalation resets that assumption.
The bottom line on Genuine Parts Company. This is a 98-year-old distribution business with the longest unbroken dividend growth streak of any company we've covered. The revenue beat in Q1 is real. The separation thesis is logical, but the margin pressure is also real, and the transformation will take time.
If you're an income investor, the 3.7% yield backed by 70 years of increases is a compelling floor. If you're a growth investor, the separation is a potential catalyst. If you're neither, and you're just looking at fundamentals, the EBITDA miss, the leverage, and the SG&A headwinds give you reason to wait for proof that margins are stabilizing.
Key metric to track from here: adjusted EBITDA margin, quarter over quarter. Not revenue, they're growing revenue. The question is whether they can turn top-line momentum into bottom-line leverage before the separation costs consume the savings. We'll leave you with a quote that Carlisle Fraser himself might have appreciated when he paid $40,000 for a small Atlanta auto parts depot back in 1928. Mark Twain once said, "The secret of getting ahead is getting started."
98 years and counting, I'd say GPC got started.
That's going to do it for this episode of Charged Alpha, your S&P 500 encyclopedia. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
Until then,
I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.